In this video, we are going to cover the second element of entire financial model, that is balance sheet. Similar to the previous module where we modeled the entire profit and loss statement, in this video we are going to model balance sheet for the current year, where we are going to go through each and every line item of the balance sheet. We are going to use this template as we go through the video. You also start building your model alongside the video. So when this series ends, you have a project alongside with you to showcase during the interviews. Hello everyone, my name is Karan Damania. I am an ex-investment banker turned founder, and through encoding careers, we help people build successful career in finance. Let's get onto the screen and discuss this entire module in detail. Alright, so we now are at module 4 of this entire financial modeling of a startup series, and this is introduction to balance sheet. In this video, we are going to cover the basics of balance sheet and understand the following topics. Number 1, what is a balance sheet? Next topic, why is balance sheet important? Following that, we have how does a balance sheet work? And finally, we are going to understand a key element of balance sheet, that is how a balance sheet gets tallied, and we are going to understand how assets will be equal to liabilities and equity. So to understand this key element, we are going to understand assets, where we are covering the current part, we are covering the non-current part, and on the liabilities part we are going to understand similarly current and non-current liabilities, and finally the equity element of the entire balance sheet. So that is how detailed this entire module is going to be. Let's get into the first element of the entire module, that is what is balance sheet. A balance sheet is a snapshot of company's financial position at a specific date. As we earlier saw in the profit and loss module, that in India we have to submit our entire year's financial statement to the government for 1 year period, and that period starts from 1st April and ends on 31st March of the next year. So that way we have to submit the entire balance sheet alongside PNL, and there is a third element of cash flow statement which we have to submit, which we are going to see in the next module. So coming back to balance sheet, we can see that it is a snapshot of company's financial position. So over here we can understand that balance sheet is representing a position of the company. Now when we talk about a position from balance sheet, we can understand that how is company looking on its sustainability basis. So based on that, we can then make decision whether this company is going to survive for long or not. So as we talk on regular basis, how is your financial position looking? And some people say that it's not going well, there are some crises, there is cash crunch that I'm facing. Or else on the opposite side, some people say that I'm investing well in savings, I have all the emergency funds ready with me, I have my investment plan, there's no liability outstanding on me, so I don't have to pay anybody loan or anything, and I am all set for my future. So that is how you analyze a company as well, based on how its financial position is looking. If it has good money in their bank account, if there are no liability that they have to pay, we can understand that it is a sustainable company and doing good in the business. So that is what financial position helps us understand, and the entire financial position has to be submitted at a specific date. A balance sheet will help us understand how is the financial position of a company looking on 31st March of a particular year. And to understand the entire financial position, it is represented in a tabular format, where on the left side of the balance sheet we have all the assets, and on the right side we have all the liabilities and equity of a company. So that is the entire snapshot that we can see, and then there is further division in the assets and liability, which we are going to understand in the coming section. Next, we are going to understand why is balance sheet important. So here we are going to dig down into the financial position pointers, which will help us understand why is it important. So point number 1 shows what business owns and owes. So whatever business owns is termed as assets, and whatever business owes to somebody, it is termed as liability. So these are two of the most important term in the entire balance sheet. Okay, so the next point is it reflects solvency, financial health, and funding structure. So we will take each point separately. It reflects solvency. So a company is said to be solvent when they have enough cash in their bank account to fund their expansion or whatever business plan they have. So you can understand that when you go through the cash and bank line item of the balance sheet. Next is about financial health. So financial health is somewhat similar to understanding about solvency of the company. If the company has enough cash, if they have enough assets under them, and their liability is limited, then it is said to be financially healthy. And next is funding structure. So going through the balance sheet, you will understand how the company is funded. As we understood earlier, that business does not have fund on its own. It has to raise capital from outside. So they could do either in debt, where they are taking particular amount and paying interest on that amount, or it could be in the form of where they are giving out a percentage share of the company to the investor and receiving funds in exchange of that. So going through the liabilities and equity section, you will understand how much is liability that they have on the debt side and how much is the equity that they have raised to fund the entire asset side of the balance sheet. And finally, we can see the point number 3, used by investors, banks, and management to assess risk and leverage. So whenever you are going for a funding round, investors will see your balance sheet and make a decision that is your business going to be stable or not. They will see the assets that you have and how you are planning to expand your business based on that particular assets in your business. When you go for funding through banks, they will see the amount of cash in your bank account, and based on that they will make decision of providing you with loans. And management can see what are some of the risk factors in their business and make decision to improve their efficiency in the overall business. Next, we will see how does balance sheet work. So over here, as we understood that there are two sides of the balance sheet. First is asset side on the left hand side, and then there is liability and equity on the right hand side. So based on that, there is a core equation that should always tally up, which is your asset should be equal to liabilities and your equity. So in simple language, if you are running a business, whenever you purchase something for your business, let's say some kind of laptop, some phone, or some furniture, that will go into your asset side, and the amount of money that you have paid for these particular assets will be coming from the liability side. Since business does not have money on its own, it is taking money from outside investors, either in form of liability, that is debt, or some other form of or some other instruments, or equity, giving out its share to that particular investor. If we understand this by a very simple example, let's assume this is asset side, this is liability side. You go to a bank and you take 100 rupees loan from that particular bank in the name of your company. Now that you have received 100 rupees for your business, you will then add in your cash account. Since cash is an asset, you can use it for your business. You will add that under asset side as 100. So that way we can see that this is tallying 100 on both the side. Next, if you purchase, let's assume a 50 rupees asset for your business, so that asset will come in your asset side. Let's assume you purchased a mobile phone for 50 rupees, so this 50 will come over here, and after that this 100 cash, 50 will get reduced, so this 100 will come down to 50, and both these numbers will tally up to 100, so that you have 100 in your liability to pay back to bank, and you have 50 as an asset and 50 as remaining cash. So that is a simple example of how balance sheet works. Now if you would have raised money through equity, giving out equity shares, then this 100 would be added to equity side, and there would be no liability in your business. So the key outcome that you can make going through the entire balance sheet is what does the company have and how is it funded. Next, we are going to see the line items of balance sheet, and after completing all the explanation, we will go to building the entire model on Excel. So let's start with the first item of balance sheet, that is current asset. Over here we have description points about current asset. It includes cash, accounts receivable, inventory, and short-term investment. On the asset side, we have the first header as current asset, and under current asset we have line items of cash, accounts receivable, inventory, and short-term investment. Now talking about cash, we understood from the previous example, whenever we are raising funding for business expansion, we add that particular amount to cash. Now talking about accounts receivable, suppose you did a business of selling a product to one of your customers for 10,000 rupees. Now that you have done business for 10,000, you will record this 10,000 in your revenue. That will go to the P&L segment. But suppose that the customer did not pay this 10,000, and he said that he will be paying after 30 days. So that way you will add these 10,000 amount to your accounts receivable in the balance sheet side, since this is money to be received, right? So you will add this to asset, and all the current asset that you add to the balance sheet have a expiry date of less than 1 year. If that assets are expiring or realizing more than 1 year period, then you will add them to non-current asset. So current over here means that that particular asset has a expiry or a usage life of 1 year. Most of the time, all the receivables that you have to receive from your customer or your clients will be less than 1 year, because a business cannot give such products for so much credit period like a 1 year time. So most of the time you will see account receivable ranging between 30 days to 60 days for fast moving products. If it is heavy volume based business like steel, then you will see that the number of accounts receivable days will be higher, because there in the volume in which the goods are traded is very high, like in thousands to thousand crores, and there you need to give credit period to the clients or customers that you are serving. So in your balance sheet, whatever amount of account receivable are there on the 31st March, that amount you will add to the account receivable balance sheet line item. Next, we come to inventory. So over here, when you do business, let's assume you are doing a business of manufacturing soap. So for that, you will need raw material for your business to manufacture the soap. Now this raw material will be used for production of the soap that you are going to sell out in the market. Now let's assume that you purchase raw material of 1 lakh rupees, and during the production period you only utilize 50,000 worth of this raw material. Now after the entire year, when you have this 50,000 raw material in your business, you will show this as an inventory, and that 50,000 will go to the balance sheet under the line item of inventory. Since most of the business use their inventory in less than 1 year period, you will add this to current asset. And finally, let's come to short term investment. Over here, if your business has surplus cash in its account, what they can do is invest some money into stock market for emergency cash. They can do it through debt funds, or if they want to invest in long term assets, they can do it through real estate or purchasing of mutual fund. But over here, whatever amount is invested for less than 1 year period, that will be short term investment and will be added to current assets. So that was about the line items of current asset. The next point is current assets are critical for day to day liquidity, that is working capital. So whenever we are analyzing business through balance sheet, we will first see the current assets, and under that we can get to understand, after looking to cash, the account receivable, the inventory that the business hold, and the short term investment. If the business has high amounts of this current asset, we can say that it can operate in the short term very effectively, and that is what the importance of current assets are. So when we model this entirely, we will come to our case study of Sandy's company. For now, we will go to the second header of asset, that is non-current assets. So what does non-current asset include? It includes fixed assets and intangibles. So over here, let's break this down into two parts. Number one, fixed asset. So over here, as we can see, the term fixed asset, it means it is fixed in the business, which highlights that the asset will be used for a long period of time and it is long term in nature. So over here, the assets such as buildings, equipments, plant, the and manufacturing plant which you have in your business, that all heavy assets will come under fixed asset. If you are purchasing some kind of vehicle for your business for running your distribution channels, so those vehicles will also come under fixed asset. So any asset which has remaining useful life of more than 1 year will be under fixed asset. Next, we come to intangible asset. So asset previously mentioned, like building, equipment, vehicles, we can see those assets, they are tangible and they have a market value. Now talking about intangible assets, they are not tangible, that is we cannot physically see them, but they have a value for business. So for an example, if you are manufacturing some food product, for that you will need a license of FSSAI, which is a department which gives license to manufacture food products. So that way the value of that license, the amount that you are paying towards that license, can be capitalized under licenses. Here other than license can come goodwill. Now goodwill is something that you have received from customers, from your clients, and it has no tangible value. If your business is doing very good, if you are having a very good product and it is monopoly in the market, no other player is making products like you, that way you will have a goodwill attached to your business. So when a very big company comes to you to buy out your business, you can then ask for this goodwill, because you have created such good product and there is and you have monopoly in the market. You can negotiate more amount other than just the market value of your business, so that entire amount can come under goodwill. Other than licenses and goodwill, your business can have intangibles like copyright. If someone is into production of music, so they do not have a physical copy of their music, right? Previously people used to have CDs, but now that the generation has changed, everything is digital. So there are certain methods to value those copyrights, of how much revenue will this music be earning in the future, and what is its present value that we can showcase in the asset. And also whatever amount you have spent towards manufacturing of music, you can capitalize those in the asset as production for particular music. Now the assets that you are purchasing for the business, whenever you plug into balance sheet, you will show them net of accumulated depreciation or amortization. Depreciation is the amount that is charged to fixed asset or the physical asset that your business has, and amortization is charged to intangible assets, that is asset we cannot physically see. Now talking about net of depreciation or amortization, let's understand this with an example. Now let's assume that you purchased 1 lakh rupee bike for your business, and this bike was purchased in the start of the year, that is around 1st April. Now since 1st April is also start of the financial year where you start recording all the entries in your financial statement, this 1 lakh was added to your balance sheet. Now you use the entire asset for 1 year, that is from 1st April to 31st March of the next year. There was some wear and tear related to the entire bike, and the bike will not be operating at the same capacity in the next year. So that is what depreciation means. You are expensing out the entire wear and tear of your asset, and no asset will have unlimited life. So for a bike, it could be around 5 years of life period that it has, and we can then assume depreciation based on the method that we are using. It could be either straight line method or it could be accelerated method, depending on what your accounting standards of business are. So if we assume that the bike is going to last for 5 years, and if we are using straight line method, that is each year we are depreciating at the same rate. Now if we divide 1 lakh by 5, we get 20,000 as depreciation for every year. Now this 20,000 will be added to your P&L statement as expense for that particular year, and after 5 years the entire asset would have been depreciated, and there will be no asset in your balance sheet, and the P&L will not then show depreciation. So after using the asset for entire year, we will subtract 1 lakh minus the 20,000 and put an entry of 80,000 as a fixed asset in the balance sheet, non-current asset. Since this asset has more than 1 year lifetime, you will add it under the non-current asset. So in the next year, you will once again use the asset for the entire year and subtract 20,000 as depreciation, and now your balance would be 60,000. So this 60,000 will be in your asset. This 20,000 will once again go to the P&L state. So that is how entire depreciation works and how you show it in the balance sheet. So for accounting this entire depreciation and the asset cycle, we create a fixed asset schedule where there is detail mentioned about how much is the life of that particular asset, how much is the depreciation charge for this year, how much was it for previous year, and looking at that you can get understanding of the entire assets of the business. The next point over here is for our case study, which we will see when we create our model. And the final point, it is important for assessing long term capability. So as discussed previously, the current asset that we had in our balance sheet was able to portray the short term capability of the business, which is termed as the working capital. And when you go through the non current assets, you can get an understanding if the business is going to be stable in the future years, like 3 to 5 years period of time. Next, we have fixed asset schedule, which we will understand when we model the entire balance sheet for current year. Further, we will start on the liability and equity section of the balance sheet, and we have the first header, which is current liability. So when we say liability, it listening to it, we can understand that it is something that we have to pay back. So that is what the description mentions over here. It includes account payable, salaries payable, GST payable, short-term loans that the business has. So from the points mentioned, let's understand the first one, which is accounts payable. Now in your business, you will have a lot of vendors whom you are dealing with, who are providing you raw material to produce something for your clients or customers. Now when you have good relationship with those vendors, you can get some credit period from them, so that when you purchase something, you don't have to directly pay them cash. You can pay it after 15 days, after 30 days. So that will come under accounts payable. The entire amount that your business has pending for less than 1 year period will come under accounts payable. Since it is in current liabilities, all the liability over here will have an expiry date of less than 1 year. Next, we have salaries payable. So this we can easily understand that whatever amount of salary is pending to your employees or the workers that you have in your business will come under this line item. The GST payable. So the GST payment cycle is around 11 to 20 of a particular month. If you have missed those deadlines and there is particular amount pending during 31st March, then you have to add those GST amount under GST payable. And finally, we have short-term loans. If you have any loan amount that is to be paid in less than 1 year time, you have to add that to short-term loans. The next point, current liabilities represent money owed to vendors, employees, and government. So as we saw from the above points, vendors comes under account payable, salaries payable, employees, and GST to the government. And the short-term loans could be from any, it could be from friend, family, or banks. So that depends from whom you have taken the loan. And finally, we have fourth point, which is managed with short-term assets. So whatever current asset that your business has, which we looked at, like cash, accounts receivable, like short-term investment, that all will be used to pay off your current liabilities. So your cash in the account will be used to pay off your accounts payable. The accounts receivable that you receive from the clients or customers you have will be used to pay off your GST, your short-term loans, and that is how entire business runs. You get money from people who are pending to pay you, and you pay out to people whom you are pending to pay. And related to managing with short-term asset, we have a point about working capital. Now if your business is managed well, like you are able to pay all the liabilities using the current assets, then it is said that you have smooth operations. Let's assume for any business they have current assets of around 2 lakh rupees and the current liabilities, which will include the amounts of account payable. So let's assume that account payables are at 30,000, salaries to be paid to employees is at 40,000, if the GST payable to government is 10,000, and there are no short term loans. So total current liabilities of the business would be 30, 40 plus 10, which is 80,000, and you have enough money in your current assets to pay off the entire current liability. So that is how entire working capital is to be understood. Next, we will move on to the non-current part of the liability, where we have point number one includes long-term loans, lease liability, deferred tax, convertible debt. All of these are portions of the funding that you have received for your business. These are some of the fundings which you don't have to pay immediately, that is in short-term period, and that is why they are under non-current liability. So as we can see, long-term loans, which are the loans which you have to pay back in next 3 years, next 5 years. Next we have lease liability. If you have taken any asset on lease, then those assets will come under lease liability, and there will be a line item which will be created in the name of lease liability. There is a detailed calculation about lease liability, and it is entirely detailed topic which we will not cover in this video. Next we have deferred tax, that is the tax amount which you have to pay as your liability in the next year. So this is also a very detailed accounting topic which you need to understand and will need a separate video entirely on its own. And finally, convertible debt, which is an instrument which is used to raise fund, and it can be converted to equity, which are some of the terms and agreement which are mentioned during raising of funds. So that is about the non-current liability side. Now it indicates the capital structure and how business is financed. Moreover, when we understood about current liabilities, it helped us understand the operations of the business in short term. But when the business is expanding for the next 10 to 20 years, we can see from the non-current liabilities how is it going to fund those expansion plans. So over here, if the business has 1 lakh in capital, and out of that if 40,000 is funded through liability, then 40% will be debt and 60% will be equity. So you will understand the debt to equity ratio when you go through the non-current liabilities of the balance sheet. Next we have point on our case study, and final point is interest expense from these, which shows up in P&L, principal here in balance sheet. So for all the liability that you are raising through debt or loans, you have to pay interest on that, and that entire interest element will go to P&L as your current year expense, and the principal that you have left in your business will be in the balance sheet under non-current liability. So for understanding non-current liability in detail, we create a borrowing schedule which helps us understand how much is the principal amount, how much is the interest amount. We will see that entire borrowing schedule when we create our model. And the final element that we are seeing on the balance sheet line items is equity. Equity once again comes on the right hand side, where initially we have liabilities and below that we have, and on the left hand side we have assets. So if you are raising funds through equity, that is you are giving out some ownership of your business to investors, then that amount will be coming under equity. Now let's see what does equity include other than funds. So first of all, equity changes year on year based on profits, dividends or capital infusion. So let's understand this first. Whatever amount of profit your business is generating at the end of the year, that entire profit will go to equity side of your balance sheet. Since this profit is considered as cash, it is taken under asset side on the balance sheet, and to match it on the liability side, we input the entire amount of profit under equity side. If your business is doing good profits, your asset will increase, and at the same time your equity will increase. Next over here is dividend. When you pay dividends to the investors that you have, your profits reduce because you are paying dividends from profit, and that way your assets will reduce if you are paying higher dividend, and your equity will reduce simultaneously. And finally, point is about capital infusion. So going ahead in the business, if you want to raise more funding to expand your business line, you will raise funding. And if you do that to equity, that will be termed as capital infusion, and that will increase your equity, and at the same time will increase your asset as cash is getting infused into the business. Now equity is often termed as the net worth of business. So whenever a business is making profit, that entire profit is going into equity side. So other than the funding raised, equity includes element of business operation as well. So to analyze net worth, we first start with liability. If we see that business has 100 rupees liability, and when we see assets, we can see that assets are 150. So we can see that there is 50 additional amount of money into the business, and that 50 is equity. So 50 will be the net worth of business. Now this 50 would include profit, the capital infused by the shareholders into the business. You have to then analyze equity line by line of what is the amount of profits and what is the amount of capital infusion. So that will give you a true picture of net worth of the business. And the final point over here is equity sits on the balance sheet, but profits from P&L flows into retained earnings here. So as we mentioned in the first point, that the profits will go into equity and that will be termed as retained earnings. That is amount of earnings that are retained into the business and not given out as dividend to the shareholder. So that was about entire balance sheet line items. So next we will move on to the case study and create a detailed balance sheet. Okay, now we are on the template of our case study where we are now going to model the entire balance sheet, taking each and every line item one by one. So we will go through the presentation and understand the assumption for every line item. So we are starting with current assets where it is mentioned 50,000 cash in bank as initial share capital. Next is 20,000 unpaid invoices from catering orders. And finally, we have 10,000 worth of cheese, sauces, and packaging. As we understood that current assets include cash, accounts receivable, inventory, and some short-term investment that is made by the business. Now over here, we have the first line item as cash, which is the initial share capital that Sandy would have invested in the business to start running the operations. So we will first mention about cash. So we will go to the template and mention about cash. So in this template, we have created balance sheet in a vertical format where we have assets initially and then we have liabilities and equity section. So as we understood, asset has two header. First is non-current assets and next we have current assets. So these gray lines are subtotal and blue lines are the final total of assets and of liabilities. So I'll mention liabilities. So we are now starting with the current assets. So we will first input the entry of cash, which was 50,000. Next we have 20,000 unpaid invoices from catering orders. So Sandy would have given someone a catering service where 20,000 is the amount that is still to be received from the client or the customers whom we provided our sandwiches with. So this is accounts receivable for the business and we will add this to current asset, accounts receivable, and 20,000 is the amount. Perfect. Next, we have 10,000 worth of cheese sauces and packaging. So at the end of the year, 10,000 worth of cheese sauces and packages was remaining with Sandy in his business, and this we can term as inventory, which can be later used in the next year. So we will create an entry for inventory, and this is 10,000. So these are the current asset that Sandy has in his business. So total current assets. Now this will be sum of each of the items above. So 50,000 plus accounts receivable of 10, 20 and inventory of 10,000, which gives us total of 80,000 worth of current asset. Okay, now that we have our current assets with us, now let us calculate the number of days in which revenue is received in the business and the number of days in which inventory is getting cleared. So over here we have on the receivable side 20,000 as unpaid invoices, which we already know. 70% of revenue realized instantly in cash. So out of the entire 10 lakh revenue that the business has earned, 70% was instantly realized. So there are no receivable outstanding days, and 30% was on credit to catering orders. So out of 10 lakh, 30% was on catering. So that way 3 lakh was from catering, and there was 30-day cycle given to receive the money, and the weighted receivable days comes at around 24.3. So we will see how this 24.3 days is the number that we arrive at. So let's now go back to the screen, and we have fixed asset schedule with us, we have borrowing schedule which we are going to see, and then we have working capital schedule where we are going to start with accounts receivables. With us we have receivable revenue, which is 30 percentage of the total revenue earned by the business, which is 10 lakh. So that way we get 3 lakh as the receivable revenue. Next, we know that the number of days in a year in which the revenue has to be received is 365. So this is not number, I'm going to give this comma. And finally, we are having receivable days with us. So we are going to calculate receivable days, and calculating receivable days will help us forecast the next 3 years. on how is the receivable looking like in the future. Using receivable days in the future, we will then predict how much are the accounts receivable. But for now, since we have the account receivable with us, we are going to calculate the days in which that is realized. So we have accounts receivable amount, which is 20,000. So initially we need to calculate the receivable turnover. That is how many times the amount of receivable is turned into the business. So for our example, we have 3 lakh as our revenue and 220,000 is our receivable. 15 times the receivable amount. Now to calculate the number of days in which this amount is realized, we will have to divide the number of days in a year by this 15 amount. So over here, since we already have 15 and we need to divide 365 by this 15 amount, we will cell which has 365 and then put division and bracket this entire 15. So now we have 24.33 as our receivable days. So we can assume that this 20,000 amount will be received in the next 24 days after the financial year. Similarly, we will see about inventory as well. So 10,000 worth of inventory valued at COGS. So all the raw material that the business has is termed as COGS. The average inventory days is 12.2 days. Now we will calculate this 12.2 days using our Excel sheet. Next point is low holding period is equals to fast turnover of ingredients. So we will understand this point as we calculate the inventory days. Next point is lower days is equals to fresh stock plus better cash cycle. Both these points let's understand as we create our inventory days calculation. So we will come back to our sheet and this is for inventory. So we have the amount of COGS. Next we have the number of days that I'll plug in from here. And finally we have inventory days and the inventory amount. Okay, so out of these three calculation, we have inventory amount of 10,000 with us. We also have COGS, which is 3 lakh. We can take it from P&L. Just remove this negative sign. And now we need to calculate the inventory days. We will use the same formula as we did above, and for in calculating inventory days we first need to come to inventory turnover. Okay, so for that we will use the formula COGS divided by inventory. So that gives us number of 30. So that means that 30 times our inventory was entirely circled around. We purchased some goods related to making sandwiches, then we finished those goods, then we purchased more, and that way we did 30 cycles of that inventory. Now to calculate inventory days, in how many days is inventory getting finished? So we will calculate that by dividing 365 by the number of times the inventory has been turned over. So that way we will use the same formula of 365 divided by inventory turnover, which will give us 12.2, which we saw in the presentation. That is average inventory days are 12.2. So over here this means that in 12.2 days our entire inventory is getting finished and we need to buy new stocks. The average inventory days range around 7 to 15 days, because if it is more than that, then inventory that we have will become stale and it will not be usable. Final point was lower days is equals to fresh stock plus better cash cycle. So we can understand that if the inventory days are less in number, we are getting more inventories again and again, and that way we are selling out fresh stock, and as we are doing more sales, that will lead to better cash cycle. So that were points about receivable and inventory. Next we will see about non-current assets, where we have sandwich grill and furniture that we have taken for our business. So we are going to plug in this non-current asset using our fixed asset schedules, which helps us track cost, depreciation and net book value of long-term assets. So asset recorded at purchase cost and depreciation is deducted on a yearly basis. Creating a fixed asset schedule is required for audit, taxation and future capex planning. Now for our business, we can see that we have purchased grill of 1 lakh rupees and it is depreciated at 10,000 per year. So that way we can understand that grill has useful life of 10 years, which is 10,000 multiplied by 10, we get 1 lakh. And the furniture we have taken for 40,000 is depreciated at 8,000 per year. So that way the furniture has useful life of 5 years. So let us plug in these numbers in our fixed asset schedule. So we will move to our fixed asset schedule. Over here we will plug our two fixed assets. First is grill machine and next is furniture. So initially we purchased grill machine for 1 lakh and we purchase furniture for 40,000. Here we need to plug in the addition of fixed assets that we have made during the year. In the below column, we will plug in the depreciation calculation. So we know that grill machine is depreciated for 10 years. So that way we will select this grill machine divided by 10. So we get 10,000 as our amount of depreciation for year 1. Now this depreciation is done for the next 10 years. But now since we are modeling for the next 3 years, we will scale this to the next 3 years only. And it will go far up to 10 years, but now since model is small, we will plug in up to 3 years. So that way this in year 1 also we will depreciate this by 10. In year 2 also same. So rather than just manually doing it, we will fix this cell over here using F4 and then copy paste this entire formula. So that way we now have 10,000 for every year, and the furniture that we have for our business is depreciated for 5 years. As we saw, the depreciation value was 8,000 rupees. So 8,000 into 5 will give us 40,000. So similarly we will now plug in formula over here, this F4 to lock in and divided by 5. Now this is also depreciated for 5 years, but now since we have model for the next 3 years, we have depreciated it for the next 3 years. So that way we now have depreciation calculated with us. Now this two depreciation amount will go to the PNL, and we have already created our PNL and amounted depreciation expense as 18,000. So to plug in numbers into the balance sheet, we cannot plug in 1,40,000 as our fixed asset, because we have to put in numbers which are net of depreciation. So the closing balance of fixed assets will be, it will be sum of these two minus this amount. So we will write in total depreciation. So this total depreciation is sum of 10,000 and 8,000, which is 18,000, and the total fixed asset, which is 1,40,000. So we will subtract 1,40,000 minus 18,000. So this is closing balance of fixed asset for year 1. Now let's assume that in year 1 we do not purchase any asset. So this 1,22,000 will be reduced by another 18,000 depreciation for that year. So this 18,000 is the depreciation amount for year 1, and closing balance then will be this opening balance minus the 18,000. So that way we have 1,04,000 as our closing balance for year 1. So if you keep going in future years, you will see that after year 5, the entire 40,000 amount of furniture will be depreciated from the asset, and you will be only left with grill machine as your asset, which will have 5 years more of useful life. So now we will plug in this closing balance of fixed asset in our balance sheet in the non-current asset. So first item we have is furniture, and next we have grill machine. We could directly plug in 1,22,000, but just for clarity we will plug in the amount separately. So furniture was 1 lakh and the depreciation on it was 10,000. So 90,000 is the value of furniture, and grill machine was 40, and 8,000 as depreciation brings it to 32,000. So total non current assets will be sum of these two, which is 1,22,000. So that way we created our asset side of the balance sheet. We will now calculate the total assets that we have in our business, which is 1,22,000 plus the 80,000, which is 2,02,000 worth of asset. We will now move on to liability and equity side, where the first header we have is current liabilities, where it says 15,000 pending payments to bread suppliers, 5,000 staff salaries payable. Both the current liability line item that we have is about paying to some vendor or salaries to the staff. So both of this we can add as accounts payable, and in that we can mention 20,000 as our amount, or we can separately mention both of them. So we will start with our non-current liabilities. Then we have current liabilities, under which we have vendor payable and staff salary payable. So vendor payable is at 15,000. As we saw, 15,000 pending payment to bread suppliers, which will be one of our vendor from whom we are purchasing bread to make our sandwiches. And the next amount is 5,000, which is payable to one of our staff. So that way we get total of 20,000 as our accounts payable. So this is total. I'll just italic. So that completes the current liabilities. Next, we will move on to the non-current liability. Sandy took a long-term loan from a bank at 15% interest of 1 lakh rupees. So there is only one long-term liability which Sandy has, where he has taken a long-term loan from a bank at 15% interest rate, and the amount is 1 lakh rupees. So we create a borrowing schedule where we are plugging in the entire loan amount, where we are separating the principal and interest portion of our repayment amounts. So as we understood in the previous module of P&L statement, that interest on a loan can be of two types. One is flat interest, one is reducing balance. The loan amount that Sandy has taken over here, which is of 15% interest rate of 1 lakh, we have showed it as a flat interest rate. To understand about reducing balance, when we model for the next 3 years, we will understand how reducing balance interest rate is calculated. So for now, let us come to borrowing schedule. It shows loan amount, tenure, EMI structure, interest component. So that we will see when we model it. Part of financing activity in cash flow, interest in P&L, principal in balance sheet. So interest is definitely paid for the year, and principal is reduced from the entire loan amount in the balance sheet, used by management and lenders to assess debt servicing capacity. So when they see that the company does not have a lot of loan on its books and is also doing good in revenue, that time they are happy to lend those type of companies. And finally, helps create accurate projections. So when you go through the current borrowing schedule, you can understand how much you can borrow for the future years, and that way you can then project the amounts for that. So going back to the template, we now are at borrowing schedule. The first line over here would be amount of loan or debt. So currently we have 1 lakh as the amount borrowed from the bank. Next, we will calculate the principal and the interest that we are paying back. So for the current loan, we are saying that this is flat interest rate. We only need to pay 15% interest on a yearly basis, and no principal is paid back. And we are assuming that this is a loan for 3 year period. So at the end of third year, we will have to pay back the interest and the principal amount. So in year one, there is no principal paid, year two no principal, and in year three we are paying 1 lakh of principal back to the bank. And the interest is calculated as loan amount multiplied by 15% interest that we saw in the presentation, which gives us 15,000 of interest. And this interest is then calculated for next 2 years. So here we will now calculate the closing balance of the entire loan amount for that particular year. So closing balance in the year one, since we have not paid any of the principal amount, this will be same as 1 lakh. We can show it as 1 lakh minus this 0, which is same as 1 lakh. In year two, also this will remain this minus 0. And in year three, since we are paying back our entire principal amount of 1 lakh, this will turn as 0, as we have paid 1 lakh plus the interest of 15,000 or our entire loan amount. So that way, this closing balance will now go to the balance sheet as our long-term borrowing. So long term borrowing. So that way we have now completed our liabilities section. Initial part was the current liabilities, where we saw the vendor payable, salaries payable, and next was the borrowing amount. Finally, we now are at equity, which is the balance between assets and the liability. We have share capital, which is 50,000, which we will now plug in. And next is the retained earnings, which is current year's profit. So as we have point mentioned on this on equity, that every year the profits go back to the equity of the company. So that way we will now add the share capital and profits to equity. So number one, share earnings. So share capital is 50,000 and retained earnings is the profit of the company. So that was 3,41,000. So actually retained earnings is the cumulative profits of the all the years that the company is into the business. Now since we have only 1 year's data, this retained earning will be the same amount as current year's profit. So that way our equity becomes sum of these two, which is 3,91,600. So we now need to calculate the total of liabilities and equity, which is sum of 391 plus the total. So we have forgotten to take total. So total liabilities will be sum of 1 lakh plus the 20,000 of payables, which is what 20. So our total liabilities and equity stand at 5,11,600. But we can see that the total assets is only around 2 lakh 2,000, and our formula of assets is equals to liability plus equity is not matching over here. For that, you will need to see the next module of cash flow statement, where we will calculate the net cash which we need to take into consideration while adding cash to the balance sheet. and after that we can see that our balance sheet gets tallied. All right, so that was the first part where we discussed the entire balance sheet for the current year and modeled out going through each and every line item. In the next part we are going to model the entire balance sheet for the next 3 years and see each and every line item's assumption in detail. So stay tuned for the next video. If you find this video valuable, do consider liking and subscribing to Encoding Careers for more such practical videos. Do let us know in the comments what topics do you want us to cover in the coming videos. So this is it for this video. See you in the next one. Until then, this is Karan the Mania taking your leave.